Happy New Year, one and all. My name is Amy Irvine. I am the founder and a financial planner at Rooted Planning Group. We hope you had a wonderful holiday and that you enjoy the monthly chart book that we like to present. This is going to be a year-to-date view and a few little thoughts that we have about 2023. Quick recap, as you can see, the total return and pullback in 2022 was 18% down. That was the total return. That includes dividends that would be added back in. At one point in time, we saw a negative 24% as a total return for the year. You'll notice that it did not end down as much as it was intra-year, but we don't know what 2023 is going to bring early on. I suspect it's going to be a rather volatile first and maybe even second quarter. We like to show this because it shows the power of dividends, adding to the total return of the portfolio. And this is just specifically to the S&P 500, by the way. We'll get into some other areas in just a moment. We think it's important to talk about stock market cycles after a year like 2022. As you can see by this chart, it's never a smooth line like we like to draw. It's very jagged, and I used to joke around and say this is like the mountain climber stage of doing a Stairmaster. It's all over the place. It's interval, right? So the stock market hovered near bear market levels almost all over the past year. And in the long run, certainly markets are driven by economic growth and corporate earnings. Well, with the Fed raising interest rates last year, then the stock market, which tends to be a leading indicator, especially the S&P 500, knew that we were probably going to pull back into declining growth or even potentially a recessionary level. So again, the stock market being a leading indicator both on the way down as well on the way up was reflecting that. Now, we didn't feel that you should get out of the stock market because we didn't know when that recovery might occur. It's important to let those emotions go by the wayside when we have corrections like this, because as you'll see in a chart that I have in the future, we just never know when corrections will happen, and staying in the market actually ends up giving you a bigger return than even just missing 1 or 2 days of that particular recovery. One of the things that I like to look at on a short-term basis, because it shows me trends, is what's called the moving averages. And you'll see that the moving averages are starting to narrow just a little bit. Now, the year ended at about a negative 19.4%, as you heard when I did my 2-minute market recap. That actually ended up being 4 minutes. Sorry about that. But it's a way to see moving trends. And we look at the 200, the 100, the 500 as compared to the, how they're all doing. And this particular jagged line is actually the S&P 500 itself. So what you're seeing here is the orangey colored line is the 50-day moving average. The reddish colored line is the 100-day moving average, and the green line is a 200-day moving average. Where we like to see these come together is a period of inflection point, in my opinion. Now, this is on the technical side, and this is definitely in my opinion, but if they all start to narrow and come together, that's usually a sign of something. You can look back over history and see where some of those lines crossed over. So this is something that I tend to watch just from a standpoint of staying on top of what the market, is saying in the short term. We also love to look at stock market earnings to price ratio. Price to earnings ratio. The PE ratio uses the next 12 months earnings estimates, so it's sort of a forward rather than a backward looking. Valuations generally are more attractive now due to the market pullback. So we like to look at those historical averages and where the latest averages are, just as again, another inflection point of what we believe is going to be coming in the next 12 months. And right now we're seeing that it's about 17.1 times price to earnings ratio. One of my favorite charts to show people when they're talking about, how long do you think it will take to come out of any kind of bear market? What's a recovery period? Now, I, of course, don't know this for sure, but I look to history to sort of gauge some of the, projections. And what you're looking at here is a bear market and recoveries of the S&P 500 since World War II. So this is bear markets are peak to trough declines of 20% or worse, which is what we had in 2022. Have to get used to that. The chart below shows bear market pullbacks since World War II. And these, again, are the 20% or worse drops in the market. On average, the bear market sees a fall of about negative 35%. Now, we didn't see that. That's not to say that we won't collectively over the period of time that this bear market actually lasts. Last year, we did not see that, but that's not to say that the bear market has ended. Now, recoveries from that level usually take 2 years and 5 months. That's the full recovery. But when you look at the timing of some of this, like I said, we don't always know what the what the recovery from the peak to the trough is. And then I shouldn't say recovery, I should say what the decline from the peak to the trough and then from the trough to the peak is. And you can see on average, it takes a little over 2 years. So when does that 2 year actually start? That's the question. Another angle that we like to look at is definitely the bull and bear cycles. And you can see right in these charts how long the cycles usually are. The gray area being bull and the beige area, tan area being bear. And typically, now this is never guaranteed, but typically bull markets are much longer with a larger return than a bear market decline. It was in 1956 that the average bear market lasted 1 year and 2 months with a decline of 36%, where in contrast, the average bull market lasts about 5 years and 9 months with a return of 192%. So if you're looking since 1956 and saying, okay, that's all that history that is there, and the decline lasts about 1 year with an average of 36%. Is this going to be average or not? Is it going to be better? Is it going to be worse? We don't know for sure, but that's the average. And with the recovery being much longer with a larger gain, this is why we tell people to stay in the market, because we don't know when this is going to happen. Staying invested and missing those best days is so influential in your long-term return. And as you can see by this chart, if you stay fully invested, this is the past 25 years of the S&P 500, and let's just say you put $1,000, your gain as of the end of the year would have been 3 times what you actually put into that if you just stayed fully invested. Whereas if you pulled out and you waited until the market, quote unquote, recovered, you'd probably be missing the best for 40 days, and your $1,000 would actually be worth a third of what you put in there. We like to show factors relative to U.S. stocks. So if you look at the 2022 and back to 2006, you can see that the U.S. is, we're building off from that. So where did things perform off from the U.S. Market in general? And sometimes we perform almost at the top, and sometimes we perform closer to the bottom, like this year. And I like to show this because I think it helps understand that then when we talk about the importance of investing in fixed income to offset some of those losses, in most years you will see that the U.S. aggregate adds some positive return even in negative years of stock market. Now, there have been a few years, of course, where there's been some negative aggregate return on the bond side, and this year was absolutely one of them. The interesting thing about this year is that all of the bond markets were actually negative, where in most years you don't see that. There's usually some positive end of the bond market that reflects, but this has been a unique year. When we look at stock and bonds annual return, looking back to 1990, then when I say stocks, I'm referring to S&P 500, and when I'm saying bonds, I'm referring to the U.S. aggregate total return. You can see, as I mentioned in the the two-minute update, the S&P 500 closed down about 18% this year, where the U.S. aggregate closed down about 13%. Now, the average return for the S&P 500 going back to 1990 is 11%, including this year, and the average U.S. aggregate is 5%, including this year. So this is definitely a break in the historical pattern driven by the huge increases that the Fed implemented this year. And we want to wrap up the asset performance discussion by just reflecting on the balanced portfolio performance. I always joke and say that a good asset allocation means that I'm always going to have to apologize for something. So as you can see, there's usually some asset class that performs better than the balanced fund, but that means there's also asset classes that perform worse than the balanced fund. So we believe strongly in keeping your portfolio diversified. I realize I've gone a little bit over, but I just want to recap the economics of 2022 as well. This chart shows the year-over-year percentage change in an index of leading economic indicators. And you can see that the leading economic indicators have definitely turned negative for 2023. And so the indicators usually turn negative several months before a recession as the economy decelerates. This pattern is also evident over the prior 7 recessions. And definitely, I think, 2023 is going to be one of those years where intentionally the Fed is trying to slow us down, right? And just remember that the economic side of things isn't always necessarily tied to the stock market side. So we can be in a recession and you can start to see the stock market recover. What we're seeing at this point in time, in addition to those leading indicators, is you'll see that retail and non-store sales have definitely dropped year over year. We're starting to see that happen. We've also seen personal savings rates drop considerably over the past few months. Building permits have certainly dropped since 2021 and even 2020. So we have seen building permits definitely drop significantly. Existing home sales have significantly dropped as well, as you can see by this chart. This is one of the lowest that we've seen in over a year for sure, and actually quite a while. When you look at the average being about 53.49, and we're now at 4,000. The interest rates appear to be working with regards to new house sales. And then we still see the dollar being very strong as compared to some of the other currencies out there. So major global currencies have been extremely volatile over the past few years, and the dollar's strengthened in value over the past year has been influential in travel, influential in our GDP being positive because of the import-export side of things. It actually made our GDP positive in the third quarter. We hope that you've enjoyed this slightly extended 10-minute market update, and we also hope that you have a wonderful 2023.